Welcome back everyone. I hope you are all doing well. Today we will be talking about how to measure sustainability. So the big question is, how is sustainability being measured? Because it is very difficult to do so. Sustainability is usually measured by assessing performance of social, environmental, and economic principles. While balance between those three, between social, environmental, and economic principle is an ideal goal, it is not always achievable. And because sustainability has gained attention in the last few decades, organizations are now placing an emphasis on how to measure sustainability. And one method for measuring sustainability is to assess the program or the project against existing best practices. Using sustainability as a metric generally means an expansion of the traditional business reporting framework to take into account social and environmental performance in addition to economic performance. This is what we call by the triple bottom line. These three key principles should be measured, but they do not of themselves provide a measurement system. So many organizations are then developing organization-specific or industry-specific measurement tools and best practices to help them achieve the appropriate balance across social, environmental, as well as economic principles. And while balancing the triple bottom line principles to achieve sustainability is an ideal goal and may help guide the decision-making process, it won't be always achievable in every project. However, this goal of obtaining balance between economic, social, and environmental becomes much more achievable when these principles are applied across a portfolio of projects or to an entire system planning program or operations and maintenance program. That will be the focus of our session today. So, according to Wall Street Journal, recently published in 2020, the article says that a new Wall Street Journal ranking of the world's most sustainability managed firms underscores how sustainability reporting is capturing the corporate world. Not only are companies facing demands from some investors for data on their environmental, social, and governance, or ESG, risks and practices, they are being pressured by employees as well as consumers to focus on issues such as climate change and diversity. Last year, 90% of companies in the Standard & Poor's 500 index published sustainability reports, up from about 20% in 2011, according to Governance and Accountability Institute, a New York-based consulting firm. As disclosure has improved, so has the value of corporate ESG data, researchers say. Assets under management in funds worldwide that weigh sustainability factors when making investment decisions grew to 40.5 trillion US dollar this year from 22.9 trillion in 2016. So it's amazing how the concerns on ESG has grown in the last couple of years. But before we move on to the details on measurement, metrics, and indicators, I want to break up the problems that we are facing at this moment with sustainability measurement. The first problem with sustainability measurement recognized by all concerned is the different definition assigned to the concept and the widely different metrics utilized when measuring it. So central to the conceptual fuzziness has been the effort to create an index or ranking system that combines indicators of environmental sustainability with measures of companies' work to promote equity and positive community impact. And this has been an effort to combine all the good thing or all the good element of corporate behavior into a single measure. This has been criticized because this kind of thing tend to be closely related to profit. Another problem is that the assumption that these are add-ons that do not contribute to corporate profit. So the effort to measure these very different areas of performance in a single measures will make no sense at all. The organization's environmental performance and effort to be a good place to work and have positive social impacts are different things that should have different sets of measures. Another problem with sustainability measurement is that many non-governmental organizations or many NGOs depend on the revenue they generate by analyzing and scoring corporate sustainability. And this will lead to inherent conflict of interest in the current system of measurement. The problem is that we have to take into account many different fields, like from human resource management, on workplace equity and fairness, on public policy, on environmental sustainability, and so on and so forth. And all of these elements has to be measured and understood thoroughly. But this critical performance measure must be designed and regulated by government. This is quite difficult because, as far as I know, until today, the regulation on this kind of things tend to be voluntary. And there are no required sustainability reporting by publicly owned corporations and audits by organizations certified by government to conduct those kind of audits. But despite all of those problems, there are many benefits of measuring sustainability. The first benefit of measuring sustainability is progress tracking. So by measuring sustainability, we will always be up to date. We will always have a kind of indication where sustainable progress has been made and where more effort is still needed. Second benefit is that it can help us to identify our impacts. So by giving a perspective on the impacts of business on the environment, this will help us to understand the three different aspects: environmental, social, and governance thoroughly. And those kind of information will also be beneficial for business investors because investors nowadays are planning to increase their exposure to sustainable organizations. The third benefit of measuring sustainability is that it can create resilience. So, for example, during the pandemic, sustainable companies experience less negative shock return to their unsustainable competitors. So, by measuring sustainability as an internal business process, it will help us to give focus to address business risk items. And finally, the benefits of measuring sustainability is to increase stakeholder engagement. Because traditional performance measurement relate to a shareholder point of view, and this has evolved over the last 20 years or so into multidimensional performance measurement systems that accounts for different fields and different stakeholder interests. So by measuring sustainability internally, it will allow us to engage with different set of stakeholders, those interested in economic, social, as well as environmental aspect of the business. So those are the four benefits of measuring sustainability. However, if we want to measure sustainability, it means that we will need a good sustainability metrics. This can be problematic because sustainability at this moment doesn't yet have a clear and measurable definition. It needs one in order to be integrated in our day-to-day decision making. Secondly, sustainability reporting by companies is growing, with measures such as provided by the Global Reporting Initiative or GRI that we will be talking about it later on, or with those developed by the Sustainability Accounting Standards Board or SASB. However, there are many challenges with those kind of reporting because those kind of reporting mostly lack comparability, lack of rigor, and lack of independent audit. So another problem is that the number of different measures often vary in scope and scale, and more importantly, those are all voluntary. Moreover, we need a generally accepted set of definitions and indicators for measuring sustainability, so that everyone within private companies and public sector organizations can understand and utilize those indicators. The public sector here has played an important role in sustainability reporting, and this trend is growing across the world. For example, in France, the government is a leader in mandatory sustainability reporting, and many other nations are beginning to implement reporting standards and laws. In Indonesia, for example, we can start with a National Commission on Sustainability Metrics to develop a national set of standards. To make things less complicated, let's divide sustainability metrics into two different kinds. The first kind is what we call by direct metrics. The second one is what we call by indirect metrics. The direct metrics consist of produced energy, energy saved, and life cycle costing. On the other hand, indirect metrics consists of geological region, government influence, lifestyle, spatial relations, and human comfort. So what is produced energy? Essentially, there are a lot of different ways to produce energy, and the key to zero energy building, for example, is the mechanical system that produces energy to balance our energy in and our energy out. We can focus on a couple of things to get a better understanding on them. So again, there are a lot of different ways to produce energy. Some method can be quite environmentally friendly, while some others can be dangerous to our environment. Now let's move on to the energy save. Energy save is essentially about operating costs to generate energy. If we can use less energy compared with facilities with similar features and things like that, then the rate of our energy being saved is high. So the focus here is how can we increase the energy saved from time to time without sacrificing our effectivity, our efficiency, and our productivity. What about life cycle costing? Life cycle costing analysis or LCCA is related to but not a direct measure of sustainability. The LCCA does produce a sustainable quantitative metric that can be compared for best efficiency. The most cost-effective solution is not always the most environmentally ideal choice, and LCCA helps us to identify that. For example, a building that consumes little energy but costs more to maintain the energy, then it means that the energy cost is safe. Now let's move on to the indirect metrics. The first indirect metrics is geological region. The geological region affects the circumstances to achieve sustainability. The aspect to achieve sustainability changes whether it's a warm, cold, dry, or wet climate. For example, solar energy and thermal heat from the ground's surface might be the main focus of energy production for a city near the desert, while heat exchange from a large body of water might be the main focus for a city near a lake. Another indirect metric is government influence. So the role of the government is very important here because government can give incentive to innovate. The government can give a kind of subsidy so that the public can try to find out the efficient design or environmentally effective design. So the government became the carrot rather than the stick. They have to promote things so that the public can find a way to become much more innovative while at the same time also become environmentally friendly. The next metric is lifestyle. A sustainable design is one that influences a sustainable lifestyle for an occupant. This is a very important idea that reflects on many ideas, including the elimination of cars, for example, in a consumer's daily routine. And the space that we occupy for the majority of our day can have the biggest impact on our lifestyle. So again, we have to be thinking very carefully about our day-to-day activities because our lifestyle can change or can impact our environment. The next metric is spatial relation, and this is a very neglected aspect of sustainability. Spatial relations is the utilization of designation for each individual space of a specific system or specific project. In this case, where the arrangement of the space produces the most efficient results. So for example, a floor plan that designs a basic hallway or room intersection into a common area for passive solar energy to enter the house will be much more relevant or will be much more beneficial when we are comparing it with other kind of design. Essentially, it's the idea of making every space count more. So by designing our space to be more efficient, it will also increase our ESG performance. Finally, the last metric is human comfort. Human comfort is becoming very important and it is closely related to how much energy is being consumed. For example, if you are not feeling comfortable, then you will increase the amount of energy being spent through mechanical systems to make yourself much more comfortable. That is why it is very important to consider what will be more comfortable, because by making things comfortable, then overall we will consume less energy. So after considering several indicators and metrics to measure sustainability, let's move on to the accounting for sustainability. This is quite interesting because for developing countries like Indonesia, we depend heavily on natural resources. So for example, we cut forests down and then it will result in soil fertility being depleted. It will also pollute our water supplies. And because of that, Indonesia as a country becomes poorer. So national accounting is about recording market value of those kind of things like timber, agricultural produce, industrial output, and things like that in its contribution towards the GDP. We know that our natural world provides us with so many things. So for example, our resources will become the input into our production processes like our mineral, petroleum, oil, fish, forests, and things like that. But on the other hand, we have to think environmental as a service function because environment is becoming a basic habitat for clean water, for a sustainable climate as well as for other animals and trees. By thinking about environmental as a service function, we have to think about water filtration provided by the wetlands or erosion control provided by our trees and things like that. And finally, we should not forget that our natural world is also becoming a sink function. What I mean by sink function is that our natural world has the capability to absorb the pollution and waste generated by our day-to-day activity. So for example, if we use car every single day, then the exhaust will dissipate into the atmosphere. Those kind of things is part of the sink functions. Previously, environmental functions were treated as provided for free and that we have unlimited amounts of resources. But recently, we have to change our mindset. We have to change our perspective because we are now facing the problem of depletion of resources, degradation of environmental services, and the overuse of environmental sink function. Because of that, we need a new measurement to take into account the environmental factors being adjusted to our net domestic products. So for example, when we are calculating our GDP, our gross domestic product, we have to take into account the depreciation from both manufactured capital as well as natural capital. We have to consider the depreciation of natural capital in monetary terms rather than in physical units like biomass, volume, or habitat area. We also have to calculate all types of natural capital depreciation in monetary terms, but we also have to realize that calculating all types of natural capital depreciation in monetary terms can be very difficult and quite challenging. So this is the problem of natural accounting, because to calculate everything is obviously not easy. In the case of Indonesia, between 1970s to 1980s, we can see that our environmentally adjusted net domestic product is very different compared to our GDP or our gross domestic product, because in this case we deducted the value of depreciation for different natural capital like oil, forest, and soil. And the result looks like this. As you can see here, there is a significant gap between our GDP and our EDP. After adjusting our GDP with resource depreciation, you can see a significant gap of 1 to 2 or to 3 billion rupiah, and the gap is continuously increasing from time to time. This is to illustrate the importance of calculating natural resources into our GDP, because without doing so, we tend to ignore our environment. According to the research, natural capital depreciation can amount to a very significant portion of GDP. For example, in the case of Indonesia between 1970s to 1980s, the rate is about 20%. So the natural depreciation offset was about 20% of total economic production. GDP here presents overly positive assessment of social welfare and tend to ignore our environmental impact. Also, we have to take into account the differences in GDP growth rates. For example, in our case, the GDP growth rate is about 7.1%, while our EDP growth rate was about 4%. So there is a significant gap over there. And finally, we have to carefully think about the monetization of natural capital, because in 1970s there was oil crisis that result in increasing price of oil. So how do we value our environmental factors? There are at least two different approaches. The first one is damage cost approach. In this case, we assign a monetary value to an environmental service that is equal to the actual damage done when the service is withdrawn. The second approach is maintenance cost approach. In this case, we assign a monetary value to an environmental service that is equal to what it would cost to maintain the same standard of services using an alternative method. So what can we learn from this case? The first and the most important thing here is that GDP is not to be confused with national well-being, because GDP tend to be overly positive. It tends to ignore our environmental impact. And we have to realize that there are many missing and misleading elements of GDP. For example, our household production, our human and social capital formation, our defensive expenditure, our financial debt, production methods that reduce rather than increase our well-being, also the rising inequality, and so on and so forth. So the lesson here is that we have to consider many alternative indicators that adjust and supplement the GDP. So we should not only using GDP to measure everything. We have to use, or we have to consider other indicators that have much more comprehensive measures. So let's move on to the more micro perspective of sustainable measurement. What does sustainability look like as an internal process? Again, unfortunately, there is no straightforward answer at this moment, because in internal working of businesses, we have to consider, or we have to realize that businesses are very complex entities. Different companies, different size, different industries, different scope, and things like that will result in different factors that should be considered. And we also have to realize that we should use different kind of data to be utilized in order to have a good measurement of our environmental activities. So because of this, implementing sustainability will obviously require different audiences to be considered. Internally, sustainability needs to address everybody from the board right down to the ground floor, from the top executive to our workers. Externally, our audience will also vary from investors and sustainability experts to the common eco-conscious consumer. So, sustainability performance will mean different things, depend on the audience, depend on the businesses, and consequently, we have to carefully pick the appropriate way to utilize and present this kind of information. Again, there are many different ways to approach sustainability measurement, and let's take a look at them one by one. Number one, we can use sustainability measurement as point value scorecards. So point value scorecards means that sustainability activities are entirely initiative based. We can use this to track different aspects of sustainability throughout our operation. We can use this to generate numerical scores using a point system. We can also use this kind of initiatives to be categorized according to business areas like office space, service room, transportations, logistics, and so on and so forth. And by using a point value scorecard like this, it will give us an easy way to tackle initiatives one by one. It will give us a good measurement to evaluate and to compare different business areas. Another thing about point value scorecard is that it can help us to communicate how well our organization's activities align with environmental and social initiatives. For example, the Green Business Bureau certification program attributes three levels of sustainability performance depending on how many points a member business achieve. It can be aware, it can be gold, or it can be platinum. This is very similar to the Indonesian version of Prosper certification. Under this view, platinum level members elevate their reputation as sustainability leaders, and they can exemplify their commitment through a real-time eco score that can be assessed publicly. Number two, we can use sustainability measurement as an internal audit. So sustainability auditing and reporting evaluate the sustainability performance of a company using different indicators. The most popular global reporting processes are like ISO 14001, the natural step, or triple bottom line accounting. These global reporting standards examine business actual operating methods and compare these to pre-established best practices, which organization can transcribe into their own internal auditing system. Common sustainability reporting guidelines, such as Global Reporting Initiatives or GRI, can be used in combination to ensure the accuracy of internal sustainability reporting. And according to research, about 62% of executives state that the biggest challenge is integrating sustainability throughout the organization. So what does a sustainable business look like using an internal audit sustainability measure? A sustainable business is one that meets the requirements set out in the internal audit. This kind of standards and the focus of the audit will specify the sustainability areas an organization scores highly in versus how the organization needs to improve. Number three, sustainability measurement as benchmark setting. So sustainability benchmarks systematically evaluate business performance relative to a sustainability standard, company, NGO, or other stakeholders. Benchmarks provide a reference point to assess trends, to measure progress, and baseline global data in a range of sustainability parameters. Benchmarking in sustainability covers a wide variety of entities, and the most common being sustainability standards, certification, or similar initiatives or programs, like ISO 14001. Another example is policies, commitments, and performance of companies in the supply chain. Indeed, it is important for businesses to identify which standards of sustainability tools are appropriate for their needs. Once identified, benchmarks act as market signals, indicating what sustainable business behavior should be. And what does a sustainable business look like using benchmark as a sustainability measure? Benchmarks have material implication for trade and investment flows, allowing brands, consumers, companies, and finance actors to define what is acceptable and what is necessary. Meeting benchmark standards drives the uptake of responsible and sustainable practices, filtering out unsustainable operations. Sustainability measurement number 4. That is sustainability metrics and data. This will resonate as a core component of business sustainability performance. For example, carbon footprint calculations have become a popular metric among organizations and individuals. Carbon footprint data is only one sustainability metric among many different indicators that can give vastly different information about an organization's internal workings. Sustainability metrics for businesses can be categorized as environmental, social, and economic. Environmental metrics usually generate hard data of an organization's environmental inputs, outputs, and overall impact. Typically, it will relate to air and water quality, level of greenhouse gas emission, biodiversity, and the condition of our ecological systems. Social metrics indicate our social performance to reflect a company's attitude towards and treatment of its employees, customers, partners, and society at large. And finally, economic metrics, it will include specific economic indicators that track the creation of wealth, of value, and report its distribution and reinvestment for future growth. An example of environmental metrics is that carbon footprint will measure the total greenhouse gas emission caused directly and indirectly by our organization. We can measure the carbon footprint of our business using Business Carbon Footprint Calculator. An example of social metric is the benefit of a percentage of payroll expenses compared to annual charity contribution, and so on and so forth. And an example of economic metric is research and development expenditure compared to percentage of sales. So what does a sustainable business look like using sustainability metrics? Sustainability metrics mean very little when presented in isolation. However, using this kind of metrics alongside benchmarking, auditing, and point value scorecards can help us to create a framework for evaluating sustainability performance and leading evidence-based policymaking. It should be noted that some aspects of sustainability are difficult to quantify because of the interrelated complexities of the real world and lack of global standards, as I mentioned just a minute ago. We can also use hard numbers to launch our green initiatives and track our progress. In operation, we are very familiar with lean manufacturing and Six Sigma. Those kind of concepts are proven to be a very efficient framework for organizations to make sustainability improvement. For example, using the Six Sigma methodology, we can rely on the DMAC. We have to define our business process that need to be improved. We have to measure our current process performance. We have to analyze our data. We need to improve our process. And finally, we have to control our process to maintain optimized performance. If we are doing this step-by-step phase of the MAIC, we can help our organization to increase the sustainability and also to continuously improve the operations. By combining the MAIC with quantitative sustainability measures, this will provide a formal and structured means of how to use hard data to launch green initiatives. So let's move on to the DMAIC in a much more detail. The first step is that we have to document our process. If we want to work with Six Sigma or continuous improvement or total quality management, then first we need to document our business process, which can be alleviated by using process documentation software like BPM platform or business process management platform. Process documentation gives a visible representation of our business operations. This means that we can both focus on individual components and stand back for big picture thinking and acknowledge how different processes interconnect each other. By documenting our business process, it will help us to think about all of our business process thoroughly. But then it is not easy because the process can be very daunting. To do so, we have to identify and name the process from the core business process first, and then we have to define the process scope, we have to explain the process boundaries, and the next we have to identify the process input. We need to brainstorm the process step by gathering team information from process start to finish. And then we need to organize the steps sequentially to create a process flow. We need to describe who is involved, who is responsible. We need to make note of exception if there is any. And finally, we have to add control points and measurements. So there are lots of things that can be done in order to document our business process. Step 2, we have to pick the processes to be improved. We need to ask several questions like which process are used most frequently, which process that have the highest output, which process that are very critical for our business operations, which process that probably can provide the highest sustainability return, which process that are expected to be the most degrading to our overall sustainability performance and things like that. And the studies indicate that processes selected for improvements should be based on objective information. So in order to do that, we have to clarify our process scope and goal. We have to identify our process-related sustainability metrics. And finally, we need to define the data collection method. In step 3, we have to measure our current process performance. We need to compare between before and after because it will help us to quantify the effectiveness of process changes being made. Research indicates that establishing reliable and applicable sustainability measures will help us monitor key process characteristics and performance towards the process goals detailed in the defined stage. And we can also use these sustainability measures along with other quantitative analysis like comparing feedback from our employees or analyzing our customers' opinion regarding our products and services. Step number 4, we need to analyze how to optimize business process to increase sustainability. As I mentioned just a moment ago, quantitative measures can be used to reduce the gap between current performance and our desired goals. Using the gap analysis technique, we can examine and we can also describe this gap in performance. So this analysis stage is essentially about identifying process waste and opportunities for performance improvement. In order to do this, we need to ask questions like this, like how long does it take to complete every task in the process? Are these tasks irrelevant? Will this task benefit from green investments, for example? Or can the efficiency of any task be improved? Or can parts of the process be automated? And so on and so forth. In step number 5, we can improve our process continuously. We can act based on the collected data, based on the information and our insight, so that we can make beneficial adjustment to our business processes and move closer to our sustainability goals. We can adapt different processes to be moved to the testing phase. We should have inter and intra-departmental employees to run these processes and provide feedback on whether the changes made were beneficial or not. So we should involve different people from different departments to measure and to analyze our processes. And finally, in step 6, we need to control our processes for ongoing sustainable performance. For true process control, we will need to regularly review the business processes with the questions of sustainability in mind. Depending on our level of seniority, this can involve sending our processes to the appropriate authority for review and further approval. We also have to communicate process changes to the relevant department. We need to answer any questions put forward and explain what changes have been made, why these changes have been made, and what sustainability improvements are to be expected. We need to ensure all employees perform the improvement processes in a uniform manner, in a standardized manner. We need to set up a mechanism for ongoing monitoring and institutionalizing the improvement actions taken. And to operate more sustainably, organizations have to adopt sustainability as a core business component. Sustainability measures can quantify internal sustainability performance and be used in combination with process improvement frameworks like the MAIC. Now, let's talk about the principle of measurement fundamentals. Measurement fundamentals essentially refers to the principles that underlie valid measures. Measurement approaches that violate these principles can be misleading, incomplete, inaccurate, and lead to conclusions and decisions that differ from those that would be reached based on valid and precise measures. So, what are the key ingredients for valid measurement? The first one is object of measurements, like when we compare apples to apples. Second is the properties of measurement, like roundness, cost, colors, and things like that. Third, like unit of measures, like quantity, currency, and things like that. Fourth, precision based on the scale, whether it is nominal, ordinal, interval, and ratio. And finally, its commensurability. When can I validly add or subtract one measure compared to the other? And those measurement fundamentals are actually baked into the traditional transaction-centric accounting paradigm, but those need to be specifically considered outside that paradigm. So what is the transaction-centric accounting paradigm? Essentially, many people assume that accounting measures assets and liabilities, but this is not completely true because the principal object that traditional accounting measures is actually a transaction. And the property measured is transaction value, which can be revenue or cost. And the unit of measure is usually currency as of the date of the transaction. And finally, the scale and precision for currency is ratio. And the fact that traditional accounting measures are based on third-party transaction is arguably one of its greatest strengths, as well as its most important inherent limitation. If what we want to measure cannot be measured using a transaction, like value creation in advance of its realization through a transaction, for example. Another problematic thing on accounting measurement is intangible. Intangibles arise from a transaction. Intangibles are usually self-generated and meet specific criteria that eventually can appear on balance sheet. For most intangibles, the concept of market or fair value doesn't apply for at least three different reasons. The first one is that many intangibles are non-tradable, like your reputation, like your image or your company culture and things like that. The second reason is that even for tradable intangibles like patents or data or algorithm like Google, for example, comparable market values usually don't exist for things like that. And for most intangibles, the value streams they can generate really depends on the context, and most have limited value outside a relevant context. So for example, patent A can generate for company B differs from that it could generate for company C. So it will really depend on each company's complementary business assets. So patent A is actually on its own has a very limited value. And the value concept that does work for intangibles is actually incremental value in use based on the extent to which an intangible contributes to future value streams in the company context. And advocacy efforts promoting better disclosure of intangibles should focus on supplementary information about intangibles, including cost and incremental value in use that I explained just a moment ago. What about the capital? With the exception of financial capital, for which the underlying object is transaction, the other capitals which depend on the specific framework may include manufactured, intellectual, human, social, and relationship, and natural are actually a construct, not objects that can be measured. And if these constructs are disaggregated sufficiently to become measurable, then the underlying objects, properties, and units of measures are diverse and not commensurable. So while thinking about the stocks of capitals work as a conceptual analogy and supports value creation from a process perspective, it is not technically possible to measure the value of stocks of non-financial capitals in a valid way. Consequently, quantitative measures related to the capitals are usually expressed as metrics or indicators. And from a value measurement perspective, it can be easier to quantify many of the underlying components of the capitals as flows or value streams than stocks. These are the things that make measuring capitals is very challenging. Now let's move on to the metrics and indicators frameworks, including the ESG frameworks that we discussed earlier. There are actually two principal technical measurement challenges that arise related to any framework of metrics or indicators. First, given that a framework is necessarily selective and arbitrary based on the chosen metrics or indicators, how can we know that the framework is faithfully represents the underlying reality? Second, how does a user achieve a holistic perspective on a value or performance from a framework of metrics or indicators? What I mean by this is that in accounting, comparing composite values like net income, net asset, or cash flows usually provide holistic perspective on overall financial performance and whether overall financial performance is getting better or worse over the time. But how does one achieve a similar overall understanding from a metrics or indicators framework? This is quite difficult. And there is also a tension between these factors because more comprehensive and complex frameworks are more likely to better reflect the underlying reality. But the more comprehensive and complex the framework, the more difficult it is for a user to achieve a holistic overall perspective on that underlying reality. Another thing that we have to think about is how do we monetize impacts? Because monetizing impacts typically involves several measures, assumptions, and conversions to represent our ecosystems or social impacts in units of currency. For the end result to be valid in relation to measurement fundamentals, each step in the process must be valid. How precise can monetized impacts be? For instance, like if monetizing impacts were to involve a string of 5 calculations, plus or minus 10% error at each stage could result in a cumulative error of more than 100%. So this is quite dangerous, to be honest. And in many cases, the resulting level of precision can be better expressed as a range estimate than a point estimate. And any attempt to add or subtract transaction-based values and impact-based values will create a commensurability issues or commensurability problems because these are different measurement objects. The question is, will the resulting values be sufficiently valid so as to be reliable for decision-making purpose? How do we ensure that users can have sufficient and justified confidence in the results so as to be able to use them for decision-making purposes, for example? These are the issues that arise from monetizing impacts. The other thing that I want to talk about is the future value streams and events, because the concept of event-based value streams was actually developed as a methodology for measuring value creation. This is similar to the way value realization is measured using transaction. Value streams can be financial or it can also be non-financial and measured from the perspective of the organization as well as from the perspective of stakeholders. Modeling future streams involves inherent uncertainty because it's tough to make prediction, especially about the future. There are several methods that can be used to deal with this uncertainty. For example, we can link assumption to events. We can use full disclosure of our assumption and events. We can also use sensitivity analysis. We can enable our users to view the results of substituting their own assumptions and events. We can explore different scenarios. We can track the ratio of past and future events influencing a model. And we can also attach probability distributions to events and scenarios. And while financial value streams can be aggregated, developing a holistic perspective on many non-financial value streams remains a challenge, because it is similar to that discussed just a moment ago related to metrics and indicators frameworks. Measuring social impact, measuring non-financial attributes can be very challenging. And before I conclude my presentation for this session, I want to give you a distinction between ESG and impact investing, because in many cases those two are often overlap or interchangeable, where actually ESG and impact investing can be quite different. So let's talk about ESG first. ESG originates in business strategy, financial potential, and it will filter based on doing no harm, on economic and environmental and society risks, as well as corporate governance practice. Impact investing is very different, because in impact investing, the origin was in investment to align with the intention and to serve the market at the same time. So the intention is to contribute to solution for societal changes. In ESG, the deployment is usually using a kind of scorecard to understand company performance, to measure the minimum threshold, and to deploy every resources through public markets. But in impact investing, usually we use systematic impact alignment assessments to identify and source investment, and we deploy everything through private markets. In ESG, we use ownership position to suggest our performance improvements, and we regularly report on ESG performance. But in impact investing, we actively seek ways to deepen our positive impacts for all stakeholders, while at the same time also addressing the negative impact. We report on outputs and outcomes where possible using standardized metrics. And finally, the ESG exit is about to selling shares and redeploy proceeds as desired, and then compare performance in ESG versus non-ESG investment. And usually there is no required reporting on change in impact performance. But when we are talking about impact investing, we have to conduct exits considering effect on sustained report, and those has to be publicly disclosed. Now, if we align the SDGs that we have already discussed in the previous session, we can align the 17 goals with ESG. So we can make ESG the core of our business model. In this case, IFC performance standards and corporate governance methodology has provided several performance standards, like performance standard number 1 is on risk management, performance standard number 2 is on labor, performance standard 3 is on resource efficiency, performance standard 4 is about community, performance standard 5 is on land resettlement, performance standard 6 is on biodiversity, performance standard 7 is on indigenous people, and performance standard 8 is on cultural heritage. And we can divide all of those things into different sustainable development goals. Like, for example, no poverty can contribute to PS number 4 on community as well as PS number 5 on land resettlement. Zero hunger, on the other hand, can contribute to PS number 6 on biodiversity. Climate change or climate action can also contribute to PS number 4 on community as well as PS number 3 on resource efficiency. So essentially, all 17 goals are actually relevant and related to ESG. Finally, when we are talking about measurement, we have to integrate values of ESG as well as impact investing into our day-to-day decision making. And in this case, the knowledge on accounting is very essential. The knowledge on enterprise value is essential. We have to measure our enterprise value by combining traditional financial accounting and auditing of ESG, plus measuring our social capital, our human capital, as well as our natural capital. But also, on the other hand, we have to measure our impact claims and data to substantiate our activities. Those are the more coherent approach toward measuring sustainability in the case of organization or companies. And last but not least, when we are talking about sustainability, please don't forget that measurement is only one thing. The other thing that we have to take into account is monitoring as well as reporting. And by combining measurement, monitoring, and reporting, we can use all of those aspects all together to help us in decision-making activities.